Let's talk markets now with Eric Lynch, portfolio manager at Scharf Investments. And Eric, are we set up for disappointment if the Fed doesn't follow through on the number of rate cuts that people are hoping for this year?
Yeah, Joe, that's a great question. I think we could be. You're looking at obviously market forecasting 5 or 6 rate cuts. The Fed's kind of sticking to 3 or so in the dot plot. We got an S&P 500 trading at 20 times earnings, flat earnings growth this year. Dirty little secret of the last 3 months, while the investor set has basically been celebrating the Fed's dovish turn, is that the estimated earnings growth for Q4 S&P 500 has trended down from 8% on September 30th to just 1.3% as of today. So earnings guidance is coming down. We've got a 12% earnings estimate for growth for 2024. It would assume all-time high margins, Joe. So that's a problem. There's definitely some downside risk here.
There's other things as well, I think, Eric. And if some of the leadership were to shift, I mean, things don't grow to the sky, and we'd be. I don't know where we'd be without the Magnificent Seven. Maybe that's a good thing. But do things catch up, or do they come back down to earth?
Yeah, I love that analogy. Here in Northern California, we got redwoods all around us. They're great trees, but yeah, they don't grow to the sky. Mag 7 was up on average 110% in 2023. What's really interesting, Joe, is you're starting to see a broadening out of the market. And so in December, during the Santa Claus rally, shockingly, the Mag 7, despite that big print for the year, was only up 4%. The equal-weighted S&P 500 index, which I call the boring 493 facetiously, was up 7%. So you actually started seeing rotation in December. The first week of January, the Mag 7 also declined much worse. Defensive sectors like healthcare was up 2% last week, equaling its whole return for the year in 23. So utilities, staples were up as well. So you're definitely seeing some sort of kind of rotation and broadening out. That's probably a healthy thing for markets in terms of the sustainability of the markets going forward. It could look a lot like post-tech bubble, Joe, where the large cap growth tech stocks, the U.S. kind of ate the world in the 90s. And then it kind of lagged all sorts of different styles going for the next several years. So it's not a bad thing if the Mag 7 kind of slows down. In some ways, it's kind of an indication that there's a dearth of growth. And so if we get a reflation in the economy, I think the broadening out works. If we get a kind of harder landing, the Mag 7 are really kind of elevated here. And so I think either way, both those scenarios, broadening out, getting more diversification in the portfolios is a really important way to play.
Well, that's a fine line that we walk. If we get 10 rate cuts because we have negative GDP, is the market going to be at 12, Dow going to 80,000 because we get 12 rate cuts, but it's because of a recession? You see what I'm saying? I mean, the more rate cuts we get, the weaker the economy. So it's just difficult to handicap things. It's got to be just right.
Yeah, exactly. It's got to be just right for the Mag 7. That's why I think investors would be, smart to look at some of these defensive sectors that didn't do anything in 23. Like I said, healthcare up 2%, utilities down 7%, staples were down last year. All of them were up last week. You can get a bunch of these securities at 15, 16 times earnings versus the S&P 500 at 20, the Mag 7 at 30 to 40. So if things do slow down, Joe, these companies have kind of, high earnings resilience, which is kind of GDP insensitive. I think that's going to be important as the year progresses.